So in May of this year, the NASDAQ changed one of its most important rules. And I want to be clear about something right from the start. Nobody broke any laws. This isn't a conspiracy. But what happened is genuinely wild. And if you have a retirement account with any kind of index fund, this rule change is directly affecting your money right now. On May 1st, the NASDAQ officially adopted something called the Fast Entry Rule. And here's what we know for certain. This rule fundamentally changes how quickly companies can be added to the NASDAQ 100 index. Before this change, when a new company went public, it had to wait at least 3 months before it could be added to the index. 3 months. That was the waiting period. But under the new rule, that waiting period is now just 15 trading days. 3 months compressed into 3 weeks. Now I know that sounds like a small technical change. It probably sounds boring. But here's why it matters. There's approximately $600 billion in assets that track the NASDAQ 100 index. That's not hedge funds. That's index funds and ETFs that regular people own through 401ks and retirement accounts. And here's the key thing. When a company gets added to the NASDAQ 100, all of those index funds are automatically forced to buy that stock. They have no choice in the matter. Their job is to track the index, so they have to own whatever is in the index. So the NASDAQ just shortened the timeline for when that automatic buying happens. And at the exact same time, they made 2 other changes. First, they eliminated the minimum free float requirement. Free float means the percentage of a company's shares that are actually available for regular people to buy and sell. The old rule said a company needed at least 10% of its shares trading publicly to join the index. The new rule says there's no minimum. A company could have just 5% of its stock publicly available and still qualify. And then there's the third change, which is where things get interesting. For companies with less than 20% free float, the NASDAQ now calculates their market cap in a specific way. They take the actual free float and multiply it by 3 for weighting purposes. So a 5% float gets treated as 15%. A 10% float gets treated as 30%. Now why does this matter? Because when index funds buy, they're trying to buy in proportion to the company's weight in the index. When you artificially inflate how big that free float appears to be, you're essentially forcing index funds to buy more shares than they would otherwise. You're manufacturing demand. So we have 3 things. A shorter timeline, no minimum float requirement, and a multiplier that artificially inflates demand. All 3 changed at the same time in May 2026. And then in June, SpaceX filed to go public. Now, I'm not saying the NASDAQ changed these rules specifically for SpaceX, but I am saying the timing is what we might call interesting. So what exactly is SpaceX? Because here's what most people get wrong about this company. If you ask people on the street what SpaceX does, they'll say rockets. Some might say Mars stuff. And sure, SpaceX does those things, but that's only part of the story. SpaceX is actually 3 very different businesses bundled together, and they don't perform equally. There's the rocket business. That's the one everyone knows about. Launches for the US government. Cargo missions to the International Space Station. NASA contracts. That business generated approximately $4 billion in revenue last year. $4 billion sounds big until you remember this company is being valued somewhere between $1.75 and $2 trillion. $4 billion in a $2 trillion valuation. That's less than 1/5 of 1%. So that's not where the real money is. Let me show you where it actually is. The second business is Starlink. This is a satellite internet company. The basic idea is simple. Instead of getting internet through cables in the ground, you get it from satellites in space. Starlink launched in 2020, and 6 years later, it's reportedly the fastest scaling telecom company in human history. There are more than 10,000 Starlink satellites in orbit right now, each one beaming internet down to dishes on people's roofs. In 2025, Starlink generated $11.4 billion in revenue. That's roughly 70% of SpaceX's total revenue. And here's the really impressive part. The profit margins on Starlink are absolutely absurd. Last year, the margins hit 63%. 2 years ago, they were at 41%. That's 20 percentage points of margin expansion in 2 years. These aren't just good margins. These are accelerating margins. This is a business getting more profitable faster. And Starlink isn't stopping at consumer internet. There's a maritime version for ships, an aviation version for commercial airlines, a classified defense version for the government. This is the real business. This is the one that actually works. But then there's the third business. And this one is where the story gets complicated. In February of this year, SpaceX acquired a company called xAI. It's an artificial intelligence company. And according to multiple reports, xAI was valued in this deal at somewhere around $200 to $250 billion. For context, here's how other AI companies are valued. OpenAI generates approximately $24 billion in annual revenue and is valued at around $850 billion. Anthropic generates over $30 billion in revenue and is valued around $400 billion. But xAI, which by most estimates generates around $1 billion in revenue, was acquired at a valuation in the $200 billion range. Now xAI was originally founded with 11 co-founders, all researchers from places like DeepMind, OpenAI, and Google. Heavy hitters. But according to reporting, by early 2026, at least 9 of those original 11 have reportedly departed the company. Kyle Kosich went to OpenAI. Christian Szegedy left in February 2025. Igor Babushkin left in August. Greg Yang left in January 2026. And others have followed. Now Elon has publicly stated that XAI needs to be rebuilt from the foundations up, which is the polite way of saying they paid billions for something that needs a complete overhaul. But here's where the analysis gets interesting. When you consolidate all 3 of these businesses together, SpaceX brought in approximately $18.5 billion in revenue in 2025, but XAI reported significant losses. So the consolidated company ended up losing money for the year, even with Starlink's massive profitability and the rocket business performing decently. A loss-making company, valued at $1.75 to $2 trillion, going public, right after the NASDAQ shortened the timeline for index inclusion. Now here's where we need to talk about what happens next, because this is where retail investors and your retirement account come in. The traditional IPO process works like this. A company goes public. There's a price discovery period. Investors figure out what the stock is worth. Then, after 3 months, if the stock gets added to the index, passive funds have to buy it. The old system gave the market time to catch up. The stock price could adjust. Things could settle out. But the new system doesn't work that way anymore. SpaceX will go public. Within 15 trading days, they could be added to the NASDAQ 100. And when that happens, every single index fund tracking the NASDAQ 100 is going to automatically buy SpaceX stock. No choice. No discussion. The mechanics just execute. Your 401k will own it. Your retirement account will own it. You won't have voted on it. You won't have analyzed it. The system will have bought it for you. And here's what makes this interesting. SpaceX is reportedly planning to allocate 30% of the entire IPO to retail investors. 30%. Most IPOs give retail 5 to 10%. SpaceX is giving them 30%. According to reporting, the CFO told investment bankers that this is because retail has been incredibly supportive of the company and of Elon for a long time. Translation: they're expecting retail buyers to provide liquidity at peak valuation. They're counting on enthusiasm to help absorb shares at the highest possible price. So here's what we can actually conclude from all of this. We know the NASDAQ changed the rules in May. That's confirmed. We know SpaceX is planning an IPO in June. That's confirmed. We know they're planning for a massive retail allocation. That's confirmed. We know the company will likely be added to the index within 15 trading days of going public. The rules make that possible. What we don't know for certain is whether the NASDAQ changed these rules specifically to accommodate SpaceX. It's possible. The timing suggests something, but it's not proven. What we do know is that these new rules create an environment where a company with a massive valuation, minimal public float, and limited price discovery time can generate forced buying from index funds. And that matters because the buyers and sellers don't show up at the same time. The insiders and early investors want to lock in their gains at peak valuation, but they need someone to buy those shares at that price. And passive index funds, with their $600 billion in assets, provide exactly that. They're the buyer of last resort. They're automatic. They're mandatory. They're guaranteed. Now here's the thing about passive investing that doesn't get talked about much. It was sold to you as the perfect system. Low fees. Diversification. Set it and forget it. All of that is true. But passive investing also means giving up your choice. You don't pick individual stocks, which sounds great. You can't pick individual stocks. You own whatever the index contains. And the more assets flow into passive investing, the higher the incentive for companies to figure out how to get into those indices. Because once you're in the index, you're guaranteed buyers. 365 days a year, no matter what. Index funds have to keep buying to track the index. They have to keep owning whatever is in it. So the question becomes simple. If you control the gateway to the index and you can change the rules about who gets in and when they get in, doesn't that give you a certain amount of power? The NASDAQ didn't break any laws. The new rules are publicly available. Anybody can read them. But the rules do create a specific outcome. They accelerate the timeline. They lower the barriers. They manufacture demand. And for a company like SpaceX with a massive valuation and limited profitability, that manufactured demand is absolutely critical. So here's what you actually need to know. Your 401k is probably set to automatically invest in index funds. That's the default choice for most retirement accounts. And index funds work exactly as advertised. Low fees. Broad diversification. You own the market. But here's what doesn't get mentioned. The same feature that makes index investing convenient for you, it is the same feature that makes you a guaranteed buyer for anyone who can figure out how to get into the index. You're not making that decision. The index is making it for you. And the rules about who gets into the index and when and how quickly, those are being written by the people who run the financial system. So the next time someone tells you that passive investing is hands-off and requires no attention, remember this. It's passive for you. It's absolutely active for the people managing the indices. And right now, somebody is very actively testing out these new rules. The NASDAQ 100 has $600 billion in assets tracking it. SpaceX has a reported retail allocation of 30%. The timeline has been compressed from 3 months to 3 weeks. The free float requirement has been eliminated, and the entire structure of how index inclusion works has been redesigned. This is not a conspiracy. This is the financial system responding to the rules that exist within it. And the rules just changed.